Today I would like to analyze Caterpillar, one of the largest producer of construction equipment. If we take a look at the stock price, we had an incredible performance in the last 5 years. We are up 173%. But if we're going to take a look at the 6-month chart, we are down around 27%. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 145.62 billion US dollar. This makes Caterpillar the largest machine manufacturing company in the world. We can also see we have a dividend yield of around 1.83%, which we can see here did grow in a very good rate in the last 10 years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. You want to invest in a growing business and not a declining business. So in 2020, the revenue was around 41.75 billion US dollar. This was a 22% decrease from 2019, so probably related to COVID. Then in 2021, we saw the strong comeback with a growth around 22%. Then in 2022, we saw the 16% growth, so this is a very good growth rate. Then in 2023, we saw 12.8% growth. This is also very good. And then in 2024, we saw the decline around 3%. This is something we don't like to see, but overall in the last 5 years, we saw the good revenue growth. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 4.21 billion US dollar. This was a 0.73 decrease from 2019, so probably related to COVID. Then in 2021, we saw the strong comeback with a growth around 12%. Then in 2022, we saw the good growth around 9.3%. In 2023, we saw the strong growth around 89%. This is something we like to see. And then in 2024, we saw the decline around 9.9%. So overall, I think we had a good growth in the last 5 years. So as a check here. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024, 8.82 billion US dollar. Then we're going to divide it with the current market cap, 145.62 billion. Then we're going to get the free cash flow yield for 2024. The number we're gonna get would be around 6.05%. So I think this is a great number. We like to see that is over 4%, and this could be an indication for undervaluation. I think you should also make some assumptions about the free cash flow in the future. If we ask ChatGPT, we can see here in 2025 the free cash flow could be around 8.7 billion US dollar. In 2026 around 9.6 billion US dollar. In 2027 around 11.9 billion US dollar. So I'm not sure if these numbers are realistic. Let's assume for 2027 we can reach around 10 billion US dollar. So then we're going to divide it with the current market cap. Let me know in the comment section if you think this number are realistic. So the free cash flow yield for 2027 would be then around 6.86%. So I think this is a good free cash flow yield. This can be an indication for undervaluation. The next thing we're looking for is the debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So we're going to take the long-term debt first, 8.5 billion. And I will also explain why we not take the total debt. The total debt is around 39 billion. So this is a big difference because this company has a financial arm. So this company helps the customer to finance the products. That's why the total debt is way higher than the long-term debt. So we're just going to use the long-term debt. This is 8.5 billion. We're going to add the short-term debt as well. So the short-term debt is here 0.05 billion. And then we're going to also divide this with the free cash flow that we had, 8.82 billion. Then we're going to get the debt to free cash flow ratio. The number is around 0.97. This means a little bit under 1 year we can repay the debt with the free cash flow. So this is a good number, and it's a check here. We can also take a look at the cash on hand. So the cash on hand is around 6.17 billion. But again, we cannot use all this money as well, because it's also some of this from the financial arm. So around 70% is probably from the real business, from the machine business. So this would be around 4.83 billion. But overall, I still think this company has a great balance sheet, and we like to see that. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. This is the current market cap, 145.62. We're going to add the debt. The debt's around 8.55 billion. We're going to take minus the cash. So the cash says here around 6.17 billion. But again, we're not going to use all this money because some of this money is from the financial arm. So we're going to use around 4.83 billion. So if we're going to calculate this, we're going to get the enterprise valuation first. So the enterprise valuation would be around 149.34 billion. So this is how much the whole company is worth. Now we're going to divide this with the free cash flow that we had, 8.82 billion. Then we're going to get the enterprise valuation to free cash flow ratio around 16.93. So this is a good number, I would say. It's under 25. And again, this could be an indication for undervaluation. So the check here. But we also can calculate this number for 2027. This would be then with the 10 billion. Then we would get the different valuation. So the valuation we would get then would be around 14.93. So again, I think this is a great number, and I think this company could look undervalued right now if we think the free cash flow can continue to grow in the future. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially we think the company is undervalued. So we're going to take a look, and what we can see here, yes, this company buys back a lot of their shares. So since 2018, it was around 2.5%. Even in 2019, it was over 5%. So this is a very high rate. And in 2024, it was around 4%. So yes, we have a lot of buybacks, and it's a check here, and we'd like to see that. I would like to give my conclusion about this company, so let's start with a positive. So I think we had a good revenue growth in the last 5 years. I also think we had a good free cash flow growth as well. This is something we like to see. The balance sheet is also looking quite good. This means a low amount of debt and a good amount of cash on hand. The free cash flow yield around 6.05% is also looking quite good. This can be an indication for undervaluation. And with our free cash flow assumptions for 2027, the free cash flow yield could be around 6.86%. This is also very good. The enterprise valuation to free cash flow ratio around 16.93 is again an indication for undervaluation, and in 2027 it could be around 14.93. So I think this company does look undervalued if we think the free cash flow can continue to grow. And this company also has a lot of stock buybacks. This can help the stock price to increase as well. So I think this company looking quite good right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.